Welcome to our video on understanding universal life insurance and its potential tax implications. In this video, we will dive into the world of universal life insurance, also known as UL, and explore the various tax implications it may bring along. Our aim is to help you make informed decisions by understanding all the aspects of UL and Modified Endowment Contracts, commonly known as MECs. So, let's get started. Here's what we'll be covering today. We'll start with understanding what a universal life insurance policy is. Then, we'll delve into modified endowment contracts. Following that, we'll explain the tax implications of cashing out a universal life insurance policy. We'll also discuss strategies to avoid any MEC penalties and explore other costs and considerations. Finally, we'll suggest next steps you should take regarding your universal life insurance policy. Universal life insurance is a type of policy that blends life protection with investment growth. It provides a death benefit along with a cash value component that accumulates over time. Policyholders have the option to adjust both their premiums and the death benefit, giving more flexibility compared to traditional life policies. However, this flexibility can occasionally lead to complexities, such as creating a modified endowment contract, or MEC. Modified endowment contracts, or MECs, occur when a policy breaches certain IRS guidelines regarding premium payments. To determine if a policy is an MEC, the IRS applies what's known as the 7-pay test. This involves checking if 7 times the net amount of premiums paid within the first 7 years equals or exceeds the policy's cash value at the end of its 7th year. If it does, then the policy is classed as an MEC, which could lead to penalties on withdrawals. Now it's time for a quick quiz. What test does the IRS use to determine if a policy is an MEC? Here are the options: 7-pay test, earnings test, lifetime test, cash value test. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the 7-pay test. The IRS uses this test to assess if premium payments into a life insurance policy exceed certain prescribed limits, thereby classifying it as an MEC. To avoid the MEC penalty, the first step is understanding the mechanics of your universal life insurance policy. Make sure your policy complies with the 7-pay test to avoid classification as an MEC. It's critical to track all your premium payments accurately. Employing the expertise of a financial advisor can provide the necessary guidance to ensure compliance and avoid potential penalties. There are other considerations beyond just the tax implications. Surrender charges might apply if you decide to cash out your policy early. Additionally, many policies provide borrowing options against the cash value. It's important to consult your policy terms to understand any specific charges or conditions that may apply. Moving forward, it's advisable to contact your insurance company to secure detailed policy information. This includes any potential tax information and the cash surrender value impacts. Consulting a qualified financial advisor or tax professional can offer tailored advice fitting your unique financial situation. Don't hesitate to clarify any doubts or questions you may have regarding the tax implications. Please note that all the information provided in this video is for informational purposes only. It should not be construed as financial or legal advice. Always consult with a qualified professional to receive personalized guidance suited to your specific needs and circumstances. Thank you for taking the time to watch our video on understanding universal life insurance and its potential tax implications. If you found the information useful, we would appreciate it if you could like, share, and subscribe to our channel. We would also love to hear your thoughts, so please share them in the comments below.